developments and Saudi economic outlook. And just briefly, I'll touch on what's happening in the global economy as an introduction to talking about Saudi Arabia. But my focus is on Saudi Arabia and specifically issues related to fiscal policy and monetary policy and the economic growth of the kingdom. As all of you probably very much aware of what has had happened over the last few years, and in particular in the last few months with the growing uncertainties in the global economy. The uncertainties were driven by what had happened in the US with the growing sizable debt, as well as the sovereign debt crisis in Europe, which affected or is going to be affecting fiscal policies of these countries moving forward. The fiscal policies of whether in the United States or Europe are becoming more restrictive. And as you see in this slides, I'm trying to look at 2010 and moving to 2011 and 2012. The pressure on these governments is to tighten fiscal policies, which would mean lesser deficits as a percentage of GDP. So the policies of these countries are becoming more restrictive, which would mean more or lesser demand on goods and services created by the government of these countries. And lesser demand on goods and services obviously will contribute to slower growth. And this is what is expected to be happening moving forward, especially in 2012. The issue is not only related to government expenditure, which has been the main stimulus for growth over the last couple of years, especially in 2010 and 2011, but also is related to the private sector demand. And what I'm showing here in this slide is the employment picture. The green columns here is showing the employment participation in the OECD countries using 2005 as the base year. And as you notice here, the employment participation is falling in OECD countries. The orange line is indicating the level of unemployment level. And the unemployment level had reached 8.8, 8.7% in the OECD countries. And in fact, recent data, which just happened to be published over the last few days, indicating higher unemployment data, particularly in Europe. Not only that the unemployment level is high, but also households are very highly leveraged, are in debt. And also, in addition to that, the valuation of assets, whether we're talking about housing or equity market, had been weakened over the last few years. That will put more pressure on, more downward pressure on private demand, which would mean lower growth over the coming year, 2012, and maybe even 2013. At the global level, we're looking for a weaker growth as projected by the IMF, close to 3.5% for the world economy in 2012. However, the picture is very different from advanced economies compared to emerging economies. The green line here is indicating the level of growth for advanced economies, and as you see here for 2012, the level of growth is below 2%, close to 1.5, 1.8% in 2012. However, with respect to emerging economies, the growth is expected around 6% for 2012. This is rather subdued compared to historical levels and compared to what we have seen, especially over the pre-crisis time. We're hoping that by 2013, the picture will be less gloomier than what we are seeing in 2012. Important also to note the role of the monetary policy, especially as we look to major economies of the world. And if you look to this slide, you would notice the sizable differential between the level of interest rates in China and in India at the top in black and red lines, while the Fed and the ECB rates at the bottom. So there is a wide difference between the two. The differential is very high. However, in recent months, even China kept its rate rather flat, and the same thing for India. And we're seeing a reversal for ECB moving downward, cutting the rate. Recently also, China had used reserve requirements or cut the reserve requirements in order to stimulate growth, as seeing or observing that the world economy is slowing down, and that will impact China as well. They also resorted to cutting the reserve requirements. But there is a negligible, and here there is a negligible risk by central banks to tighten policy rates for 2012 and even for 2013. An important matter, especially for us here, to look at the dollar situation. And we are also knowing that the U.S. economy is slowing compared to last year or to 2011. But the situation is much worse in Europe, and Europe more likely to be going through a recession in 2012, a small recession close to 0.5%. While the expected growth for the U.S. is around 1.5, 1.6%, slower than the 2012 of around, or 2011 of around 2%. And for this year at least, we're seeing the dollar to be strengthening against the euro, close to the 1.3, 1.2 range for the dollar against the euro. If we look to equity markets, and I'm only here depicting what's happening in the Standard & Poor, and especially that, you know, what's happening in the U.S. equity market is influencing other international markets, including emerging markets. It is interesting also to note in this chart the impact of the quantitative easing program 2 that was implemented since November 2010 all the way to July of last year. That quantitative easing, and basically the proceeds of those sold fixed income securities to the Fed, had been channeled through the equity market, contributing to this sharp rise in the U.S. stock market and the Standard & Poor, in the, 500. Now, after with the end of the quantitative easing, we have seen the stock market to be plummeting. And then, since mid last year, we're seeing a pickup in the stock market, not only in the US, but also other international markets, mainly coming from, or the influence is coming from the US, particularly due to somehow better economic news in the third quarter of last year. Also, earnings in the third quarter and fourth quarter have been better than expected, and those contributed, along with the expectation of monetary easing 3 or program 3. All of these things seem to have influenced the performance of the U.S. stock market. Also, we have seen last year the plummeting of the commodities, and particularly in the third quarter, in October of 2011. If you look to the green line and you see the industrial metals index, and also for the agriculture index, the orange line, both of them has shown a sizable falling. For the industrial metals, 20% since the beginning of 2011, and for agricultural commodities, about 15% since the beginning of last year. However, with precious metal and petroleum products, although they plummeted in October of 2011 last year, they reversed that direction since then. Precious metals, because it's a safe haven for assets. And for petroleum, as the development that took place in our region, particularly with the disruption of oil supplies in Libya, and also the sanction on Syria and the expected sanction on Iran, all of these things had contributed to the rising of oil prices. Now I'm shifting and talking more specifically about oil as I move toward speaking with you about Saudi Arabia. Production for last year averaged close to 9.4, 9.5 million barrels a day. That is obviously attributed to the disruption of oil supplies in Libya and, you know, the outages in the North Sea, along with the political turmoil in Nigeria. All of these things contributed to rising also oil prices. And we've seen oil prices averaging above the $100 a barrel for last year, 2011. The expectation as far as 2012 is also to see oil prices above that or around the same level, especially with the current political developments in the region and the intensifying of the rhetoric between Iran and the West and the threat of closing the Strait of Hormuz. All of these things seems to be contributing to rising oil prices despite the weaker demand. So oil prices are more affected by what's happening on the supply side and lesser to be affected by the demand side, as we see that the global economy is weakening, so the expectation is to have lesser demand, but that does not seem to be affecting oil prices now. More specifically about Saudi Arabia and looking at the macro sort of picture, it's important to look at the current accounts as a percentage of GDP and fiscal balance or the budget balance as a percentage of GDP. If you look to 2011, for example, 2011, the current account as a percentage of GDP amounted to 27.6%. That's obviously very sizable. Obviously, Saudi Arabia benefited from the rising production as well as rising oil prices, achieving that level of current account to as a percentage of GDP. Now, with fiscal account, it amounted to 14% to GDP. In absolute value, we're talking about 306 billion Saudi riyals. Now, as far as 2012, we're expecting the level of production to be lesser than 2011, especially that the oil production of Libya is coming on stream or is picking up, now is reaching the 1.1 million barrels a day. It is still below its potential of reaching 1.6 by the end of the year or 1.7 by the end of this year. And that is going to be affecting Saudi Arabia's production. We're expecting the production of this year to be around the 9.2 million barrels a day, so it's lesser than or even less than that, close to 9 million barrels a day for this year compared to last year. Fiscal account is expected to be at 7% to GDP, to 1.1 trillion. 93% of those revenues were coming from oil. Expenditure due also to the royal decrees that were taken early last year accelerated the government expenditure, reaching 804 billion Saudi riyals, with the surplus amounting to 306 billion Saudi riyals. Now, as far as 2012, what was announced, and you see it here, the budgeted revenues was put at 702 billion Saudi riyals, with expenditure at 690 billion Saudi riyals. The government projected a surplus of only 12 billion Saudi riyals. And this is likely to change given what's happening in the oil market, and the government apparently assumed a conservative price for oil in their estimating of revenues. based on our analysis, the government assumed $65 a barrel for oil for 2012. And now we're seeing oil prices around the $110, $115 a barrel. So obviously what we are expecting is also another good year for the revenues of the kingdom, reaching 930 billion. And also we're expecting expenditure to be rising to 780 billion Saudi riyals, with a surplus of around 150 billion Saudi riyals. Talking about the fiscal policy of the kingdom, over the last few years, or since 2003, the government focuses fiscal policy on three dimensions. One of them is to accelerate expenditure with the emphasis on capital expenditure. As you see in this chart, the green components of this column is accounting for the capital expenditure. And the share of capital expenditure has been rising throughout from 2003 onward to 2011. Now in 2011, due to the sizable current expenditure by the government, the bonus salaries and other expenditure that were introduced in 2011, we're seeing that share to be narrowing marginally, but also in 2012, we're expecting that share to be maintained, which is a growing share. And this is going to be impacting Saudi economic growth in the medium term with the investment in infrastructure and social infrastructure. The implication will be positive, of course, on the Saudi economy, not only in the current year, but in the medium term. Now, another dimension of the fiscal policy of the kingdom is to retire the public debt. Many of you who have been here in the kingdom since 2003, they are very much aware that the kingdom was suffering from a sizable public debt, which amounted in 2003 to about 690, 680 billion Saudi riyals, nearly 100% to GDP. Over the last few years, those surpluses that were generated from the oil revenues were utilized as well to retire the public debt. Now, public debt stands at 135 billion Saudi riyals, close to 6% to GDP in 2011. That certainly helped the kingdom to improve its rating, which is now by Fitch at AA minus, and it's expected even to be AA for 2012. The third aspect of the fiscal policy is to use part of the surpluses to build reserves. And the intention of building reserves is to help the government to deal with any adverse developments in the oil market and to be prudent, not to spend all the revenues that are generated. And as you see in this chart, as of 2011, the net foreign assets of the kingdom amounted to $547 billion. This is in dollars. And part of that, which is close to $280 billion, is what is used by Saudi Arabia Monetary Agency to cover the Saudi riyal. The remaining, which is close to $300 billion, is the government reserves, which is above 1.1 trillion Saudi riyals. So this reserve is normally managed by SAMA, and it is mostly invested in fixed income securities, largely in the US. As of 2012, we're expecting the net foreign assets to be rising to $604 billion for 2012. And if oil prices remain at this level, then the net foreign assets of the kingdom, and specifically driven by the surpluses of the oil revenues, will contribute to the rising of the government reserves moving forward. Now I'm talking more specifically about economic growth, and as you see in this picture, for 2011, the level of growth in real terms amounted to 6.8%. The black line is showing the level of growth, it's the 6.8. The green component is accounting for non-oil public, or the contribution of the government to that growth, the same for the private in orange and the oil sector in gray. This is for 2011. However, due to falling production, as production will be contracting. As you will see in 2012, we'll see a contraction in the oil sector, mainly due to the falling production, because this is in real terms. So we're expecting a growth for 2012 to be moderating. We're expecting the overall growth to be around 2.5%, maybe 3%, but within that range. However, for the non-oil sector, we're expecting growth to be close to 4.5%. Now, as far as 2011, and looking at growth of the non-oil sector amounted to 7.8%. Obviously, this is a high level of growth, and this is the highest over the decade. Now, for manufacturing, we've seen a growth at 15%, and the same thing for construction of high level at 11.6%. So these sectors seems to be growing much faster than the remaining sectors. The other sectors are growing in the single digit between around 5 to 6%, as you see in this chart. Important also to follow in the kingdom is the level of contracts awarded, the mega projects that were embarked on by the government and even semi-government institutions and the private sector. But sizable reach about 450 basis points by end of last year, 2012. So this is the highest point that it reached since the inception of this index. In absolute amount, 2012 amounted for 270 billion Saudi riyals worth of contracts awarded. And you see the industrial sector in blue, power in orange, and transportation in red, accounting for larger shares of this value of 270 billion Saudi riyals worth of contracts awarded. Obviously, this is going to be impacting the Saudi economy and contributing to the value added for 2012 onward. Talking about monetary developments, I would start first. A major contribution to inflation is the rental as well as food, but we've seen rental to be sort of a permanent feature since 2007. The green component here is accounting for the contribution of rent and housing. Food is the orange. However, due to falling commodity prices and also the strengthening of the dollar, we're expecting inflation to be range-bound at around 5% through 2012. So we're not expecting a higher level. We're not expecting a higher level of inflation compared to what we have seen in 2011, within that range of 5%. Now, as far as the monetary policy, without so much elaboration on the role of SAMA, but we know that SAMA has acted during the crisis very prudently in managing the banking system and also assuring a proper supervision, all of that contributing to the stability of the monetary system and also the stability of the banking sector in Saudi Arabia. However, over the last few years, and particularly since the financial crisis of 2008, the level of deposits that were affected by the retiring of the public debt and also the level of expenditure by the government, whether current or capital expenditure, contributed to the rising of liquidity at very high levels. Now, what you see in this chart on your left-hand side is in green is the excess reserves. These are excess reserves on top of the statutory reserves that banks are required to keep with SAMA. So the green component is accounting for the excess reserves. And also you see in columns the net foreign assets and also treasury bills. The green is the treasury bills. These are the treasury notes that are bought by banks from SAMA. Now, if we look at all of them together, the net foreign assets along with treasury bills with excess reserves, we're talking about nearly 310, 320 billion Saudi riyals, worth of money that's basically not deployed in the economy. So banking sector is full of resources to deploy 2012 and 2013. I was mentioning that the slowing of the credit since when the loans or the loans portfolio contracted, but we're seeing a pickup in 2010 and 2012. And what you see in this chart is just the incremental 81 billion Saudi riyals. The overall loans portfolio is exceeding the 850 billion Saudi riyals now. Now, in the other chart is showing the loans and deposits. And what you see here in this chart as well is the loans to deposit ratio. In 2008 was around 84%. It dropped, due, of course, to the lesser appetite by the corporate sector, as well as the risk awareness on the part of the Saudi banks. But since then, there was a pickup, slight pickup in the loans to deposit ratio, reaching about 75% by the end of 2011. We're expecting the loans to be also growing in 2012. Now, with respect to performance, and this is due to the impact of the financial crisis on the Saudi banking sector, Saudi banking sector was hit in the investment portfolio in 2008. And you see the orange is showing the loan loss provisions. These are sizable provisions that were taken in 2008, especially in the fourth quarter, exceeding or close to 6 billion Saudi riyals. Then we have some issues with family businesses in 2009, partly due to the impact of the financial crisis. But since then, we're seeing the loan loss provision to be moderating, reaching its normal level. Now, in terms of profitability, Saudi banks are back to normal. The green columns are showing the profitability on a quarterly basis. In terms of return on equity, now the Saudi banking sector as a whole is around 15% return on equity. This is the last chart. I would share also with you my views on what's happening in the Saudi stock market. Normally, the PE ratio, the price-earning multiple, will correlate with the TASI index, as you see in this chart with the TASI as well as with PE. Now, in the last, since 2009, we've seen the PE ratio to be trending downward, meaning that the earnings is rising, but prices are not catching up. That's what it meant by the PE to be trending downward. The TASI does not seem to be moving, and basically there is a divergence here instead of convergence. And that divergence is indicating that the valuation of the Saudi market is attractive because earnings are rising, but not necessarily that the prices are rising at the same level. And these are my concluding remarks here. We've talked about global economic growth to be weakened in 2012. Emerging economies' growth prospects are brighter, yet they are subdued. Dollar outlook is stronger against euro. Oil prices averaging $100 a barrel, and Saudi crude production at 9.4 in 2012. It will be lesser in 2011. It will be lesser in 2012. Despite accelerated spending, Kingdom registered a fiscal surplus last year of 306 billion Saudi riyals. Real non-oil GDP as of last year, 7.8%. Value of awarded contract reached unprecedented levels at 270 billion Saudi riyals for 2011. Inflation is expected to moderate around the 5% level. Banks lending showed a pickup in 2012 and 2011, and the trend is continuing in 2012. The stock market remained range-bound despite improved profitability. Thank you very much.
Dr. Said, thank you very much. Thank you very much for your very incisive speech on the global economy and the Saudi outlook. We are running out of time because Salah time's about to start, so perhaps we can just take one or two questions from our audience. If you have the mics.
The way the Eurozone is moving, uncertainties are still there. So what's your view due to this pegging and the Eurozone uncertainty?
Banks are in dollars. So we're not in a position to worry now about the peg to the dollar, given what's happening, of course, to the euro. I don't know if I answered your question, or do you have? Is strengthening and has been strengthening since the last quarter of last year, and given that the commodities that are based in euro, and that's why we're not seeing a rise of inflation as of 2000 and strengthening of the dollar.
Would you mind giving us a copy of that presentation? If we can have an email copy later on?
Sure, not at all, yes.
My question relates to the current account expenditure at the moment, which is perhaps more than 50% of the revenue. Going forward, when Libya and Iraq and all the others come on stream fully, how likely is that going to impact in the future? What sort of pressures, budgetary pressures, is it going to put in the medium term on the government finances?
Certainly, this is an interesting question, and sustainability in the fiscal policy. And if we maintain the level of current expenditure to be going at the same level, obviously we're running the risk if there is any, adverse developments in the oil market to be facing difficulties in maintaining the same level of current expenditure. I think, the kingdom should be looking at this very carefully, not to allow the level of expenditure, especially current expenditure, to be growing at the same rate that has been growing over the last few years, even with the availability of reserves. Because if there is an adverse development in the oil market, and if oil prices to be falling back to the level of $40, $50 a barrel, then in few years we can just deplete that reserves.